Yeah.
Okay.
Number is more likely.
No, you only got one chance.
Oh, you only got one chance. Okay, don't make a mistake. Can I vote more than once?
No. You can't even see it.
I can't even see that. Can you, well, I guess we want to see who's logging in, but do you have the PowerPoint presentation?
I do.
I see.
You want me to just have it up?
No,
I can always start.
let
it
me
when
just
you
talk
say-
first and then it's not gonna matter, right? They're gonna see me regardless.
Yeah, but they'll see you in a little box
Okay.
if I have the presentation up.
Oh. I'm not sure who the hell's voting here.
Steve's on.
Steve Dowdy. Sometimes he gave me a sometimes.
I think that was Cecilia.
You think so?
I think so.
It was, I was just trying to be honest.
Oh, God.
I was gonna test the yes option now, just to see if it worked.
We'll get complaints, right? If it's not working, if somebody wants to choose yes. Camera's on you, your laptop.
Yeah, I have a camera here. But it's like grainy, that's why I like to use that one.
Yeah. Sure. Okay. Okay, thanks. John and Ferris.
Hey there.
Oh, yeah.
Block me again.
I'm doing okay.
You need to, don't vote yet. Everybody needs to wait until,
Rich, everybody's afraid to answer what they really think.
it's anonymous. It's anonymous.
Wait, it's gonna be obvious when they log in, it changes, right?
Everybody just needs to hear the story.
So
I think that,
we're gonna know how Sarah votes. Oh, there she goes. We know how she voted.
all right, what's the secret
Hey,
here?
Rich.
Hi, how are you?
Good, how are you?
I know how you voted, Sarah. It's anonymous, so we can see the score change.
Good.
Hold it up and you see the lights blink twice. That means it's fixed on.
Well, I'm actually not waving at you, Sarah. I'm trying. We had this camera that tracks you, but you have to get its attention first.
I thought you were waving high for my answer.
I'm wondering why I'm waving so many times.
Making a point.
Something wrong with him?
Well, your lighting seems a little off, Rich.
Yeah.
We go like
Is
this.
it? Oh, that's got you though.
So now let me.
Yeah.
Maybe, all right. My lighting's off.
There you go.
All right, now I'm captured. Thank you, John. Well, we turn the lights off because here we have the big screen. Because there must be at least 50 people in the audience here today, physically present. Yeah. Yeah. Hey, John, did you hear that Cheryl has another mobile home?
Oh, God. I've had a peaceful week.
I thought I'd just pre-warn you, right? You're an expert now.
Yeah, I hope it's not the one next door.
Oh, it might be. It might be in the same neighborhood.
Well, I suggested to her to actually go after it when the buyers backed out of that one for like the third or fourth time that they've been in deals.
What do we have there, Carlos? Okay.
It's too bright.
Is that that's blinding? It's okay. I
It
guess
makes
it's-
it so Rich can't see.
Yeah, who cares if I can
Actually,
say
it's a little better.
that you're blocking my camera? No, I guess not. My camera.
No, the camera's up here.
Okay. It's not quite 10 o'clock yet.
I have 10 o'clock right up.
Okay, I just saw my clock change also. So hopefully we'll have enough people to take the poll. Good morning, everybody.
Morning.
So if you notice, we have a virtual presentations skill set level poll. We're testing out the poll. But the reason the question exists is Rich perceived as being rigid or stiff. There's a real reason behind that. My wife and I have been taking dance lessons with Ryan Crutcher, who's a dance professional for years, and Ryan still does that on the side to stay active. And we had a lesson last week, and he had this new student whose name is Mary Lou, and she's on the MLS committee, and I'm on the MLS committee. Now, being on the MLS committee is not a great thing. It's volunteer work only, right? No one's being paid. But anyways, the discussion came up that they're both in real estate, and she said that she's on the MLS committee or associated with the Orange County Association of Realtors. And he said, "Oh, do you know Richard Moore?" And she said, "I do. He's kind of stiff." So the poll is anonymous. I just thought I'd see what everyone's opinion was. Now, who was honest and said yes? You don't have to raise your hand. That's probably
John
Steve.
Barris.
That's right. John Barris or Steve Dowdy, one of the two.
No, I thought there was an F in front of that. Sorry.
Frigid, huh? That was funny, John. There might be some truth in that, as a matter of fact. Well, good. Thanks for coming, everybody. Please respond to the poll if you haven't. And once again, it is anonymous, so I won't know who responded in what manner. So today with us, we have Sarah Menchaca with Southern California Funding. I asked Sarah to go over a couple of things. Actually, I had asked Sarah this past week to talk about the CalHAPA program, in which California was contributing up to $350 million for a down payment assistance program. But in 10 days of that program being introduced, the funds have been exhausted. So that was going to be our discussion today, but Sarah has some other things she would like to share with us. Sarah?
Thanks, Rich. Yeah, I have heard that they may be allocating more funds to this program, but nothing's been decided for sure. So as of right now, it's no longer available. But I do want to remind everyone that even if your buyer does not have the full 20% to put down, there are programs that are designed with mortgage insurance. And I know sometimes people get afraid of mortgage insurance. They don't want to pay it. But quite honestly, our programs, they're pretty affordable. So just to kind of give you a comparison, on a conforming loan balance, which is, again, a loan amount up to $726,200, if your credit score is good. So we would say anything above 740 or higher. In this particular example, I'm using a credit score of 760. If someone only has, their first time home buyer and they have 3% to put down, that mortgage insurance rate is 0.31%. So that's about $187.60 a month compared to an FHA loan where you'd be paying about $329 a month. To kind of further that example, if you are putting down 15%, that mortgage insurance rate drops down to 0.10%, which dollar-wise, that equates to about $60.52. So even if you don't have the 20% down, definitely have your borrowers explore the option of the mortgage insurance. Outside of that, we do have 2 additional lenders that are offering 100% financing. It's not the same, California Straight Appreciation Loan, but it is designed for a buyer who, does not have any down payment to put down. It is an FHA loan. They will give you a second up to 3.5% of the sales price or the appraised value to get that 100% financing. So the terms on the second is you are going to be paying a rate that's 2% higher than the interest rate on the first. And there are lenders that have options of either doing a 10-year second or a 15-year second. And then I also want to remind people about, using the temporary buy down to buy down the interest rate. I'm seeing this more and more on purchase transactions where the sellers are giving these incentives. So just to kind of recap, you can do a 3-to-1 buy down. So basically that means you're buying the interest rate down for 3 years. So if the interest rate today is 6.25%, you can buy down the interest rate to 3.25% on the first year. On the second year, it will increase to 4.25%. And on the third year, it would increase to 5.25%. And then years 4 through 30, you're paying the 6.25%. But you can also do a 1-year buy down. So you can buy the interest rate down for the borrower for 1 year at 5.25%. On a loan amount of $726,200, if the interest rate was initially 6.25%, they're saving about $461 a month. So, for the full year, they're saving about $5,534, which, for a seller to contribute, $5,500 towards the closing cost to buy down this rate, it's kind of a win-win. The buyer has that savings the first year to kind of see where interest rates will take them. And then obviously the goal would be for them to refinance after that year mark.
Any questions for Sarah? No, that is a pretty good program. I didn't realize it was that beneficial.
Yeah.
John, did you have something you're going to say? No? All right. Well, thank you, Sarah. Appreciate your time today. Thank you very much.
Thank you.
So today's discussion is on California real estate withholding. And I think there's confusion because the laws don't necessarily conform between federal and state withholding. So an overview for California withholding, it's just simply buyers must withhold 3 1/3% of the gross sales price on sales of California real property interests from individuals, meaning a natural person, or a non-individual, trusts, corporations, so on and so forth. And then the escrow holder has an obligation to give that notice to the buyer. And if the escrow holder fails to give the notification to the buyer in terms of the buyer's obligation to possibly withhold funds from the seller's proceeds, then the buyer is relieved from their tax liability. And also the escrow holder typically submits both the form and money to the franchise tax board. And if you go to page 2. And then we talk about sales covered by law. It states, California law states that there must be withholding on any disposition of a California real property interest. So that includes sales, exchanges, installment sales, and other types of transfers. So we're going to talk about the exemptions today. I think often when you have clients, they're wondering, oh, how do I fill out Form AS? Or how do I fill out Form 93? Well, we're going to give you some insight. Not that we want you to tell them how to complete it. But exemptions for state purposes only. If the sales price of the property is $300,000 or less, the next, the buyer does not receive written notification of the withholding requirements from the real estate escrow person. And we're going to define that. That if escrow does not notify the buyer of their obligation to withhold, the buyer is relieved from that obligation. Doesn't mean that escrow is. The next exemption would be the property is the seller's principal residence within the meaning of Internal Revenue Code Section 121. So suggesting that the buyer or the buyer's attesting, the seller's attesting that they have used our property for 2 out of the last 5 years as their primary residence. So if that's the case, then the exemption exists. The property was last used as the seller's principal residence. So it doesn't mean that the buyer or the seller rather has met the 2-year occupancy requirement. So it's just last used as the seller's principal residence, meeting the constraints of Internal Revenue Code Section 121 again. Another exemption, the seller is a corporation with a permanent place of business in California. So if the business or the corporation does not meet the following, it's not a California corporation, it doesn't qualify with the California Secretary of State. And if it doesn't maintain a staff that's permanent in California, it is not, or the exemption is not available to them. And then the property was the decedent's principal residence within the meaning of Internal Revenue Code, Section 121. So if there's an individual who's managing the estate of the decedent, and that person who is now deceased, unfortunately, lived in the property at the time that they became or passed, and it qualified as their primary residence, then the estate is eligible for the exemption. And then other items that aren't as critical, or what we don't see very often, the property has been involuntarily or compulsorily converted. So possibly the California bullet train, they're taking property via eminent domain. So if the person that owned the property sells the property to the state of California via eminent domain, they can reinvest that into a replacement property that's similar in nature, and it's similar to a 1031 exchange, and avoid any taxation on that. The property is acquired under a deed of trust or mortgage through judicial or non-judicial foreclosure, or by a deed in lieu of foreclosure. So everybody's familiar with foreclosure. Judicially means the creditor is pursuing the debtor via the court system. Non-judicial would be simply through a trustee sale. It's a much easier process. But the person that's pursuing the debtor does not have any recourse rights. And then a deed of lieu and foreclosure. Well, if the buyer's in default, the buyer goes to the bank and said, here, please take the deed. Actually, I don't want to own the property anymore. And the bank could accept it, but of course the bank is not obligated to do that. Another exemption, and this could be possible, the bank is acting as a trustee other than under a deed of trust. So what does that mean? Well, if somebody has a revocable family trust, there is a trustee named in there in regards to who's going to manage the affairs of the bank, of the grantor of the trust. There are times that an individual may appoint a bank as the trustee of the trust. So the bank is acting as a trustee, and it's a position the bank does for compensation, obviously. Then the sale is exempt from withholding. Any questions about that? And then if the seller is a partnership, withholding is not required, but it would be required for a partner that is a non-resident alien, does not have a green card, doesn't have a taxpayer ID. And the same is true for an LLC. An LLC is entitled to the exemption, but any members of the LLC, if they are considered to be a non-resident alien, they are subject to withholding, whereas the other members who are not non-residents, they are not subject to withholding. So when you look at Form 593, and we don't have it on the screen, but let's see, where are we? Thank you, Carlos. If you were to give consideration of if it's an LLC and it's a single member LLC, well, we have to look at the basis of that entity. And please, if you have questions, just cause me to pause and ask. But with a single member LLC, it could be non-recognized for federal or state income tax purposes, meaning it's just flowing through to the individual's tax return. So if there is no separate tax return completed for the LLC, then that entity is recognized for federal and state income tax purposes. But in the event it's an individual single member LLC, so the basis of completing that form is based upon the individual, and the individual, unless it is someone who owns primary residence, the exemption is not available to them. But if the underlying entity of an LLC or a single member LLC is a corporation, for example, the exemption is available to them. And then partial or full withholding. Well, we're all familiar with 1031 exchanges. And in the event there is any recognized boot, meaning there's recognition of gain, if that amount of gain recognition exceeds $1,500, then withholding must occur. But if it's a full 1031 exchange where there's no recognition of gain, then the seller would certify that they are not subject to any withholding. And then installment sales, we just don't see those too terribly often. It's probably more associated with land acquisition. But an installment sale is also known as a land contract. And it's just stating, if I'm buying a property for $1 million, I'm going to pay you $100,000 each year for 10 years. And out of each payment of principal that's paid, that could be subject to withholding. And then the other aspect is if the seller is subject to withholding, well, they have an alternative that can be withheld. So typically, or not typically, the maximum exposure for a seller is going to be 3 1/3% of the selling price. However, if the maximum tax rate for that seller, if we multiply that times the gain is less than 3 1/3%, then they can choose the alternative withholding amount. And for example, if it's an individual, that is calculated at 12.3%, regardless of what their actual tax liability is going to be when they file their tax return. Any questions?
What's common that goes with escrow? I mean, what do you see that's
I think I would say, what percentage, I don't know, but it's likely that most of the transactions are the sale for residential property or the sale of a primary residence. So the seller theoretically would be entitled to that exemption because they probably have met Internal Revenue Code section 121, where they've lived in it for 2 out of the last 5 years, or it currently is their principal or primary residence. So usually the exemption exists, but we see far more, I'll be right with you in just a second, far more transactions in which the seller is a non-resident and it is subject to withholding. So keep that in mind when you're working with buyers. The buyer has no issues in regards to any withholding. It's if in the event that person sells the property and they are a non-resident. Richard, you had a question?
Yeah, is the installment sale like a seller financing?
It could be. It could be included in that also. So they may have terms in which the buyer is paying interest on the outstanding balance, but the withholding would be based upon the actual principal payment of that installment sale, not including any interest that's being assessed.
Thank you.
So sellers have an obligation to complete 2 different forms. One is for federal purposes and one is for the state. And for the state, it's a form that escrow provides, and it's form 593. So in the event the seller does not complete the following 3, the exemption is not available to them. So the seller will not qualify if the seller does not provide the escrow holder with their tax ID. And then the exemption would not exist for them, and the escrow holder would be required to withhold 3 1/3% of the total sales price. So if somebody doesn't qualify for the exemption, they don't have the opportunity to choose alternative withholding. The withheld amount will be 3 1/3% of the selling price. So a few other details again, is withholding required when a partnership or limited liability company sells California real property? Well, the answer is no, assuming it's a non-single member LLC. And there would be no withholding if the partnership or if a partnership or LLC is taxed for federal and California income tax purposes as a traditional entity. But in the event a member, now an LLC is a form of a corporation and it's made up of members, and the members are the individuals that own the LLC. So if one of the members is a non-resident, then withholding would be based upon that member's pro rata interest in the LLC. So if there are 3 members and each have a 33 1/3% interest in the LLC, and only one of them is a non-resident alien, if the property sold for $1 million, then the pro rata interest associated with that non-resident would be $333,000, correct? And that portion would be subject to withholding. And every member would be obligated to provide escrow with the form 593, and also the form AS for federal purposes. Each individual whether it's a married couple or members in LLC, would be obligated to provide escrow with the appropriate certifications that they are or are not subject to withholding. So once again, one of the sellers in my example may meet the exemption and the other may not, and that's perfectly acceptable. And then is withholding required if the seller is a revocable trust? So revocable trusts are transparent entities. So I have the Richard Moore Revocable Trust, and it's based upon me as an individual and my taxpayer ID. So if the home I'm selling that's in my trust is my primary residence, I'd be entitled to the exemption. If I'm selling an investment property from my revocable trust, I would not be entitled to the exemption unless it's a 1031 exchange. And then is the property subject to withholding if it's in an irrevocable trust? Regardless of whether it's revocable or irrevocable, the property is subject to withholding. And an irrevocable trust, I'll give you a simple example. The Richard Moore Trust, it's revocable while I'm alive. If I'm the only grantor of the trust and only trustee and I pass on, unfortunately, everybody really sad, first of all, but then it becomes irrevocable upon my death.
Not according to the poll.
Not according to the poll, huh? I can't see the results of the poll right now. If it's too stiff, you need to let me know, all right? Just drop something in the chat box. Isn't this fun?
I think the poll's down because we're sharing the screen.
Okay, yeah, I'm sure. And then once again, is withholding required if a sale is part of a tax-deferred exchange as defined under Internal Revenue Code Section 1031. So there's a couple of types of exchanges. A simultaneous like-kind exchange. That means I close escrow on the property that I'm selling, and concurrently with that, I close escrow on the replacement property. So that's a simultaneous like-kind exchange. A deferred exchange has different rules. So I sell my property, and I have 45 days after the close of escrow to identify a replacement property. And I have 180 days after the close of escrow to close escrow on the replacement property. So once again, if I haven't received more than $1,500 in proceeds, then there is no withholding. Now, let's assume the 1031 exchange is successful and the replacement property, the purchase price is greater than the full cash value of the relinquished property, there's no withholding. But what if I enter a 1031 exchange, I've sold a property, and I can't find a replacement property, or the close of escrow on the replacement property fails? So the whole 1031 exchange fails. Well, the accommodator, the 1031 accommodator, has an obligation to withhold 3 1/3% of the gross price of that property that closed escrow. And then in addition to that, the person who was unsuccessful in 1031 exchange, their money is going to be tied up for 180 days from the close of escrow of the relinquished property. They won't have access to the proceeds for 180 days. Something we see often, relocation companies, are they subject to the same guidelines? Yes. So if it's not a company registered to do business in the state of California and it's a relo company, they're subject to withholding. If they're registered in California, it's California Domestic Corporation, they are not subject to withholding.
Richard, with the 1031 exchange accommodator, is the client in the transaction able to pull their money out early, and if they decide to do something else with it, or do they have to wait the 180 days?
Well, no, once the exchange fails,
yeah,
then no, they have to wait 180 days. But if I would assume before the 45-day time frame, regards to identification, you're just going to terminate the 1031, or actually you're not going to have a choice. You're saying I'm going to complete an exchange. And most accommodators are not willing to assist somebody with managing that transaction in other than a truthful manner. So they're not going to turn their heads and say, oh, you can take your money back. And then what if is withholding required if it's a cash poor transaction such as a short sale? So if a seller is selling a property short, and so meaning there's insufficient proceeds to even pay off the loan, is the seller possibly subject to withholding? Well, the answer is yes. Now, they may have the ability to find an exemption if there is no gain on the sale of the property, but just because there's insufficient proceeds doesn't mean that withholding is not required. And then probate estates. Probate, generally the property is subject to withholding, but of course there could be an exemption if the decedent fell within Internal Revenue Code Section 121, meaning they occupied that property for 2 of the last 5 years, or it was last known as their primary residence. Those would be 2 exemptions. And then foreclosure sales, whether it's judicial or non-judicial, there is no withholding required. And then tax exempt entities, insurance companies, qualified pension plans, charitable remainder trusts, you may see that periodically. The RTC, I don't think I've come across anything like that. They are all exempt from withholding, as a matter of fact. And then even a religious entity could also be exempt. And then the responsibility for withholding. Well, typically it's that the law requires buyers to withhold from the seller. However, in the escrow instructions, the buyer is instructing the escrow holder to manage the responsibility of the withholding itself. And then I've used the term real estate escrow person. Well, that could be an attorney. It could be an escrow company, title company, for example. It's not just necessarily always an escrow. Most likely here, it's going to be an escrow. And then once again, with a reduced amount of withholding can be requested, but it's going to be equal to the maximum tax rate times the amount of the gain that's calculated on Form 593. Then obviously there's always liability for the buyer if they don't comply, for the escrow person if they don't comply also. And it's the buyer's responsibility to keep Form 593A and Form AS, or the qualified substitute form, for 5 years following the year in which the close of escrow occurred. Everybody keeps their documents. And then you may hear the term as to what the seller's affidavit is. And the one form now that escrow always sends out, and it used to be multiple forms, but that's been combined into one form, is Form 593. And that is the document for state income tax purposes that's going to be sent to the seller. And the seller will have an option to determine whether or not they have an exemption. If they don't have an exemption on that same form, they can calculate the gain or loss if there is one. If there's a loss, there won't be any withholding. And if there is a gain, they can choose to have withheld the amount equal to 3 1/3% of the selling price, or currently for an individual, it's 12.3% of the gain that they would calculate on Form 593. And then the other form that we see in zip forms, for example, Form AS, Seller's Affidavit of Non-Foreign Status, that's associated with federal withholding. Previously, that form used to incorporate information in regards to withholding associated with the Franchise Tax Board or California withholding. It no longer does that. It just instructs the seller that escrow will be submitting Form 593, the seller's affidavit, to the seller for signature and for the seller to complete. And then lastly, must the seller's affidavit be signed before a notary public? And the answer is no. Does anyone have any questions on that? If it's not clear, please help me. Tell me.
Excuse me?
Yes.
When will our sellers ever have to pay the maximum rate of 12.3%? And like what?
Well, that would not be the maximum, would be that, or actually 3 1/3% would always be the cap, first of all. But if you were to multiply whatever that they calculate the gain on the property to be,
Yeah.
times 12.3%, if that number is lower, they can choose to pay the lower amount. So that's the advantage of using the maximum tax rate as opposed to 3 1/3% of the gross selling price of the property.
Okay, thank you.
Sure. As I said, I'd say for most people, if it's a primary residence, likely they're going to be entitled to the exemption. And if it's a California corporation, they theoretically will be entitled to the exemption. Do we have any other questions? Anything in the poll?
I think there's people that joined after.
Has everybody participated in the poll today? You have? Okay, I want to make sure because I don't know how you're responding. It is completely anonymous. That's what I was told.
What is this now?
Anonymous. I think that's fair. I'm dying to know who said yes. Come on, who wants to go forth and tell me the truth, right?
Hey, Richard, that was me. Said I thought it was a joke. So I just wanted to contribute.
I admire your honesty, say that. That's funny. That's funny.
I don't think you're rigid or stiff. I think you're cool.
Yeah. Well, thank you. I appreciate it. Anybody else want to come forth with some nice things to say about me? No one. You can say anything you want, right? You know, but what you can't do is change your response. We tested that also. You can't change the vote that you placed already.
Do we get points for this?
Oh, yes, you get points for that. Right on.
How if I leave and then join again?
Okay. You might be
Like
able to.
several times and saying yes, yes, yes.
You must be a realtor. You figured out how to work the system. That was good, Sarah. I assume that's the case. Well, hey, thanks for coming, everybody. Don't forget to contact Sarah Machaka if you have any questions about financing. And thanks for attending today.
Thank you.
Thank
Bye.
you, Rich.
Thank you.